Okay, dear students, Assalamu alaikum and good afternoon to everyone. Let's just start. SBR pre-scene mock December 2025 debrief. I will try my best to discuss each and everything in a very limited period of time because when the video becomes very long, students they just lose their, I would say, focus. Let's read the requirements. Question 1, we know that 30 marks on consolidation. Part A, using Exhibit 1 only. Explain how the fair value adjustment affects the measurement of Zacharias goodwill at acquisition and Waitangi company's consolidated statement of comprehensive income for the year ended 30th September X6. How many marks? 4 marks. Student, first you should be able to understand what exactly the requirement is. Explain how the fair value adjustment affects the measurement of goodwill at acquisition. Whatever you will be explaining, you have to tell us the impact of that fair value adjustment on goodwill. At what time? At acquisition. That is point number 1. After that, with Waitangi company's consolidated statement of comprehensive income for the year ended 30th September X6. Then also tell us what is the impact on consolidated statement of comprehensive income. So basically when we'll be discussing part A, so keep in your mind, logically your answer should highlight 2 points. One, what is the impact of fair value adjustment on goodwill at acquisition? Second, is there any impact of that fair value adjustment on consolidated statement of comprehensive income? If yes, what is that impact? If you are writing so many things but you are not covering the exact requirement which examiner is asking, so you will be losing marks. Exhibit 1, we will be just focusing fair value adjustment impact on goodwill and let's say group P&L. Let's go for exhibit 1 first. 4 marks, okay? Let's see. Exhibit 1, exhibit 1. Waitangi company is the parent of manufacturing group whose financial year end is 30th September X6. On 1st October X5, Waitangi company acquired 80% of Zacharias equity shares. Exactly start of there you acquired 80% of Zacharias equity. Can I say if parent has acquired 80% of Zacharias equity, it means NCI is 20%. 60% of Jenny's equity. Stop. If 60% Jenny's equity, it means NCS. Logically 40%. 90% of Hassan's equity, it means NCS 10. The following exhibit available on the left hand side of the screen provide information relevant to the question. Exhibit 1 actually belongs to the fair value adjustment on acquisition of Zakaria, which has 4 marks. Let's read what they are saying. Exhibit 1. Exhibit 1. Do we have? Yes, it's here. On 1st October X5, when Waitangi acquired control of Zakaria, the net assets of Zakaria had a carrying amount 5 million and a fair value of 6 million. Carrying amount 5. Fair value is 6. So obviously the difference is 1 million, which is your fair value adjustment. The difference between carrying amount and the fair value related to property, plant and equipment had a useful life of 4 years. From 1st October X5, the fair value adjustment has not yet been accounted for. Okay. Depreciation has been correctly classified as an operating expense. Zakaria's goodwill has been impairment tested and no impairment loss has arisen. Now, student, first of all, you should be able to understand the mistake which they have done. Actually, they have ignored the fair value adjustment, and the amount of that fair value adjustment is, can I say, 1 million. Student, I'm explaining each and everything in my own wordings. Listen it nicely so that later on you can even write in your own wordings. So at least the problem is in front of us. Now, what is the issue? First, you need to understand. I'm just highlighting that. Can I say logically they have understated the net asset at acquisition? I'm just giving you the answer plan. They have understated net assets at acquisition. And the value and that the net assets are understated by, can I say, 1 million. Now try to understand. If you understate the net asset, it means you can say that logically you have overstated the goodwill. If you understate your net assets, it means you have overstated the goodwill. So basically, by ignoring that fair value adjustment of 1 million, they have actually understated the net asset and they have overstated the goodwill by 1 million. Okay. Now, obviously, we will increase net assets. We'll increase the net asset by 1 million. Obviously, when we'll be increasing the net asset by 1 million, goodwill will reduce. Already what has happened, they have understated the net asset. Instead of 6, they have just taken 5. They have overstated the goodwill. Obviously, when we'll be conceding that fair value adjustment, net asset will increase by 1 million at acquisition, goodwill will reduce by 1 million at acquisition. Okay. What else? Now let's talk about one more thing. Then I'll come to the depreciation one. Zakaria's goodwill has been impairment tested and no impairment loss has arisen. So you can say we don't have more information. You can say one more point. That even though net asset will increase by 1 million at acquisition, goodwill will reduce. But again, that 1 million fair value adjustment is not going to cause any impairment loss. So logically, even the change will come in the goodwill, but that change will not lead to the impairment loss in the goodwill. It's hardly a 1 million change. Okay. Now the main point. Fair value adjustment. Actually, the fair value adjustment belongs to the property, plant and equipment. Fair value adjustment belongs to the property, plant and equipment. And the value of that fair value adjustment is 1 million. They have given us the useful life at acquisition 4 years. It means due to this fair value adjustment, there will be additional depreciation. Can I say there will be additional depreciation of 2,50,000. And that additional depreciation will go to operating expenses and will increase operating expenses in group SOCI. Operating expenses will increase by 2,50,000. My story does not end here. What is the holding percentage of parent in Zakaria? Let's go back. 80%. If parent is having 80% holding, so you need to explain one more thing. What is that? Obviously, operating expenses will increase by 250. There's no doubt about it, but you have to explain more to the examiner that 20% of additional depreciation on fair value adjustment will actually given to NCI will reduce NCI. So 250 into 20%, I'm getting 50,000. With this 50, NCI value will reduce. So student, I'm explaining each and everything. For 4 marks, it is more than enough. I think it's maybe enough for 6 to 7 marks. First, you need to tell your examiner that right now what they have done, they have understated net asset at acquisition by 1 million, which means goodwill is overstated. When we will incorporate fair value adjustment, net asset will increase by 1 million and the goodwill will reduce. Next point. This change in the net asset and reduction in the goodwill, that will not lead to any impairment loss. Next point. There's a fair value adjustment belongs to the depreciable property, plant and equipment. So the additional depreciation of 250,000 will increase the operating expenses. Next point, 20% of additional depreciation will be allocated to NCI, and that will actually reduce. NCI value will reduce by 50,000. That is more than, I would say, far more than enough for 4 marks if you discuss all these points. So if you are there in the class since the start of the mock debrief, I strongly believe everything is clear to you. Till here, student, any question you can ask? I strongly believe it should be clear to everyone. Any question? Or all okay? That is, we have just done part A. Now let me tell you. Operating expenses will increase by 250. NCI will reduce by 50,000. What I want to tell you, just focus on this. They have given us pre-populated SOCI. I just want to tell you what exactly you need to do. It's here. Operating cost is here. Operating cost is 6,000. Negative. How many zeros we are ignoring? 3 zeros. So can I say this operating cost will increase by 250? Students, please reply on that. This is what we have just written. Operating cost will increase by 250. So I have to show this in negative. Operating cost, this is what we have just explained also. That operating cost will increase by 250. There shouldn't be any problem at all. Okay. But the story does not end here. We have also explained to our examiner that operating expenses will increase by 250 and 50% of this, no, sorry, 20% of this, which was, I think, 50, will reduce NCI. Do we have NCI somewhere? We should be having NCI. I can see NCI here, 1,000, I believe. Non-controlling interest, students, it will reduce by 50. NCI will reduce by 50. I strongly believe it is clear to everyone. Okay. We have got total comprehensive income also. Of course, NCI will just not reduce. So NCI will be reduced by 50, will be reduced by 50. I hope till here everything is clear. Yes or no? Please reply. And then they have given us one more thing. Profit attributable to owners of the parent. Students, I hope till 50 everything is clear. Just tell me yes or no. Majority is with me. They're saying till 50 everything is clear, no issue at all. Just one more thing. What is the percentage of parent? Parent percentage is 80%, am I right? We have increased the operating expenses, there's no doubt about it, but we are just adjusting the pre-populated associate. Operating expenses, they will increase by 250. Can I say with 80% will be additional depreciation technically 80% will be allocated to parent, 20% allocated to NCI. If I take of 250, profit attributable to owners of logically can I say it will reduce by 200? Student, please reply on this. Additional depreciation due to additional depreciation of 250, operating expenses will increase by 20% we have given to NCI, which has reduced the value of NCI because examiner has given us NCI value. 80% will reduce the profit which is attributable to parent. I think now all the impacts we have considered, nothing else is left. This is what you need to do while preparing the pre-populated SOCI. You will be just giving a heading. Let's say you can say adjustment number 1, or you can do this. Just a minute. Fair value adjustment, there's no harm at all. Fair value adjustment, property, plant and equipment, and then the impact. You will just keep opening the columns. So this is the first column which you will add in your pre-populated SOCI. That fair value adjustment 250 will increase the operating cost, 200 will increase the profit attributable to parent's equity holder, and 50 will reduce the profit which is actually will reduce the NCI share. Okay, let's go back to the question. That was all about requirement 1 and adjustment 1. See what is the requirement 2. So students, I've explained part A here. Also how it will impact the pre-populated spreadsheet, I have explained that also. Now let's read part B. Using exhibit 2, calculate the goodwill arising on the acquisition of Jenny and impairment loss following its impairment review. Student, this look at the question. It is starting from calculate the goodwill. Look, what was in part A? Explain. If in part A you directly jump for the calculation, you will be seriously losing marks because the question says explain. What is part B? Calculate the goodwill arising on the acquisition of Jenny. Number 1, we need goodwill. Second, impairment loss following its and the impairment loss following its impairment review. So after impairment review, tell us the impairment loss amount as well. Explain how this impairment loss should be accounted for in Weitengi's company's consolidated financial statements. Explain how this impairment loss should be accounted for in Weitengi's consolidated financial statements. So you have to just explain how to account for impairment loss in group financial statements. There are three things, students. Calculation of goodwill is one, impairment loss is two, and how will you account for that impairment loss in group financial statement three? I hope, see, if you are in a position to break the requirements like that, it becomes easier when you will be answering an exam. You know that I have to highlight 3 points. We don't care if you highlight these 3 points, for example, if you are able to highlight 1 point in 2.5 lines, it's good enough for us. But the main point is goodwill, we just need calculation. Impairment loss, we need calculation, and we need explanation regarding only impairment loss. So student, let's go for part B, exhibit 2. Exhibit 2, exhibit 2, exhibit 2, exhibit 2. Goodwill calculation and Jenny. What is the holding of parents in Jenny? We have 60% holding, okay? If the impairment loss comes, technically, don't forget the holding, but we have to see the goodwill method also. Weitengi company acquired 60% of Jenny's 1 million equity shares on 1st October X5, again, start of there, paying consideration 10 million. Wow, wow, wow. When the fair value of net asset of Jenny was 8 million. Wow. Parent paid 10 million. When the net asset, they had a fair value 8. Jenny's share price on 1st October X5 was $4 and non-controlling interest is to be measured at fair value. It means full goodwill method. And we know that in case of full goodwill method, if the impairment loss comes, that impairment loss technically will be shared between parent and NCI. But in case of partial goodwill, if impairment loss comes, then entire impairment loss belongs to the parent. Jenny's assessed as a cash generating unit. Student, if you recall, in case of cash generating unit, if I have to allocate impairment loss, the sequence is, if you have any specifically mentioned asset, go for that. That is going to be number one. Like if XYZ asset is destroyed, lost, something like that, it's going to be number one. Then number two will be goodwill. But normally, most of the time, it is number one is the goodwill, and the second, all other assets on pro rata basis, which fall in the scope of IES 36. Gen is a cash generating unit, and at the reporting date, at the reporting date means year end, has net asset 10 million. A recoverable amount is 11.6. So the last information which examiner has given us, this is for actually performing impairment review, impairment test. Student, there are three requirements. First, we have to calculate goodwill. Second, impairment loss. And third, you have to explain how to deal with impairment loss. Okay, fine. And goodwill method is full goodwill. Let me just tell you. Let's first calculate value of NCI at acquisition, just to show you. Subsidy is having 1 million shares. 40% belongs to NCI, so no issue at all. Let's come here. Part B. Part B. I'm just solving here to save the time. We need goodwill. That is the requirement number one. Consideration paid Student, can I say parent has paid 10 million? Fair value of NCI. Fair value of NCI at acquisition. Subsidies total number of shares, they are 1 million. These are number of shares. So I'm writing 1000 because we are ignoring 3 zeros. Parent's holding is 60%, so obviously NCI holding is 40%. At acquisition, subsidies share price is $4. Question, let's see. Thank you. We're getting 1600. It becomes 11,600 if I'm not wrong. Less fair value of net asset at acquisition which they have given us. Fair value of net assets at acquisition 8 million. Here comes a goodwill 3,600. Now let's perform impairment review, impairment test. Oh, that has become a heart. Wow, 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 wow. I'm not good at drawing, but okay. Impairment review. Basically, if carrying amount of your net asset, it is more than the recoverable amount, then difference is impairment loss. Let's see. At the reporting date, net asset they are 10 million. Okay. Net assets, again we have to ignore 3 zeros. Oh, oh. 10 million. Goodwill, we have just calculated. So carrying amount of net asset including goodwill is 13,600. Recoverable amount. If recoverable amount is lower than 13,600, difference is your impairment loss. If recoverable amount is more than that, then there is no impairment loss. Wow, wow, wow. 11,600. Student, we are having an impairment loss of 2,000. I strongly believe that calculation of goodwill and impairment test is crystal clear to everyone. Please reply yes or no. I'm waiting, students. Here's the calculation of goodwill. Goodwill is here. Impairment review is also in front of you. Should not be disturbing you at all. Story does not end here. Now, actually, you need to explain how to deal with this impairment loss. Now, listen to me carefully, student. There are 4 marks, if I'm not wrong. Within that 4 marks, examiner has actually tested, asked 3 things. One is goodwill, we have done. Let's say take it 1 mark at least. Then examiner told us go for impairment review, we done that. Let's say 1 mark. Then examiner has specifically asked us impairment, calculated the impairment loss we have calculated, assuming we have taken so far 2 marks. So maximum I'll be having for explanation, examiner is going to give me 2 marks. Maximum 2, minimum 1. If impairment review and calculating impairment loss, it is for 2 marks, then explanation is for 1 mark. Otherwise, explanation maximum for 2 marks. And in explanation, you just need to tell what? How to deal with impairment loss in group financial statement. Now listen carefully. I'm just telling you what you need to, and they have not asked specifically, students, group SOCI, they said group financial statements. First, when you will be explaining the accounting of impairment loss, you will tell that, can I say goodwill carrying amount will reduce by 2000? Yes or no, please, student reply. That will happen. Examiner is not asking me, just go tell me what is going to happen in SOCI. He said financial statements. So I'm just explaining my examiner what this impairment loss is going to do. Number one, the goodwill will reduce by 2000. Second, now try to understand. In group SOCI, we will take this 2000 to operating expenses, operating category. Logically, this 2000 will increase your operating expenses, your operating cost. In group SOCI, depreciation we took to the operating cost. Similarly, impairment loss we will also take to the operating cost. So basically, your operating cost in group SOCI will increase by 2000. Another impact. What is the parent's holding? I believe 60. Am I right? So can I say this impairment loss of 2000, it will be actually allocated 60% to parent and 40% to NCI, and I have to give the reason to my examiner as well. The reason is full goodwill method. Because in case of partial goodwill method, entire loss, if there is an impairment loss, then entire loss belongs to the parent. So it means if I take 60% of 2000, I'll get 1200. This is 800. Am I right? Now listen to me. Can I say profit which is attributable to parent's equity holder, it will reduce by 1200 and NCI will reduce by 800. These are the impact. These impact are good enough for 2 marks. I'm just repeating it again for you. Goodwill carrying amount will reduce by 2000 at reporting date due to impairment loss. Second, operating costs will increase by 2000. And this impairment loss, 60% will be allocated to parent and 40% to NCI because it is a full goodwill method. 60% impairment loss is 1200, and with this 1200, profit which is attributable to parent's equity holder, it will reduce by 1200 and NCI value will reduce by 800. Student, kindly reply. I believe entire explanation is clear to everyone. And what we are right now discussing, it is good enough for 2 marks. Student, please kindly reply. I hope everything is clear to everyone. Yes. Okay. Story does not end here. Let's come to the. And student, I'm deliberately solving this on one note, okay? Because I strongly believe on one note, I can bring more clarity and it is more clear to the students over the period of time which I have taught. So this is my conclusion, that this brings more clarity to the students. At the end of the day, obviously, you will be doing entire theoretical stuff you will be doing on MS Word, and pre-populated, we know how to do it. We have done it in our live classes as well. So you have to do on the spreadsheet. Now, this was the first adjustment, fair value adjustment. Then, of course, second adjustment, we have ignored 3 zeros. Don't forget that. Second adjustment, can I say impairment loss? This impairment loss will increase operating cost by 2000. Operating cost is in negative, so I put a negative sign here. But story does not end here. Why? Can I say parents holding is 60%? Parents holding is 60%. So 60% of this impairment loss will reduce the profit attributable to parents equity holder, and 40% will reduce NCI. Is here. If you take 60% of 2000, you will get 1200. This 9000 is profit attributable to owners of parent. So can I say, oh no, I hope everything is fine. It happens. It's a very delicate. Oh. Okay, still manageable, I believe. Okay, I think it has become more clear. Let me just remove this. Okay, fine. Second adjustment, can I say profit attributable to parents equity holder will reduce by 1200, NCI will reduce by 800. I believe all the impact which you have to show in your pre-populated SOCI, they are clear to everyone. Kindly reply. And this is the way to deal in exam also. If you have done with the, for example, exhibit 1, whatever impact that exhibit 1 is having on pre-populated SOFP, SOCI, or maybe a cash flow statement, directly go to that last part and adjust that and then come to the exhibit 2. In this way, what happens? By the time you have done with the, let's say, 4 or 3 exhibits, automatically the last part is will already be done. In this way, you can save the time. Now let's go back. This was all about part B. Okay. Now let's see then. Again, student 4 marks. We have done part B, student, and what is the impact of part B on pre-populated spreadsheet? Revise, I would say, statement of comprehensive income. I have explained that also. Using exhibit 3. Explain. Look at the student requirement directly. It is starting from the word explain. How the foreign exchange differences should be classified in Wetengi Company's consolidated statement of comprehensive income for the year ended September X6 in accordance with IFRS 18. Presentation and disclosure in financial statement 4 marks. Student, read the requirement again. Using exhibit 3. Using exhibit 3. Explain how the foreign exchange differences should be classified in Wetengi Company's consolidated statement of comprehensive income for the year ended 30th September X6 in accordance with IFRS 18. So let's see. Exhibit 3. Exhibit 3. Wow. Exhibit 3. Exhibit 3. This was exhibit 2. Student, here comes exhibit 3. Okay. Wetengi Company has certain foreign exchange differences. Okay. And these have all been correctly calculated at net loss of 180. There are foreign exchange differences. Number 1, story does not end here. Then the examiner says they have calculated that properly. No issue at all. And the net is a net loss. However, the directors have not applied the requirements of IFRS 18, presentation and disclosure in financial statements, and have classified all exchange differences as operating expenses. Okay. The foreign exchange differences comprise 200,000 loss relating to overseas loans incurred by Wetengi company. They have taken a foreign currency loan. On that loan, there's exchange loss of 2 lakh. And a 20,000 gain on retranslating of 100% overseas subsidy. Okay, finally, at least examiner has given us the breakup of 180. And the question they have directly asked, explain the treatment of these exchange differences. Okay. Now, sir, first of all, please try to understand. According to IFRS 18, any item, any transaction which is affecting the P&L, okay? You have to bring that item to the relevant category. If you recall, IFRS 18 technically, logically gives us 5 categories. Operating category is number 1, investing category, financing category. We have got discontinued operation category, we have got income taxes category. And I always say the last 2, they are very easy. The main thing is operating, investing and financing category. So according to IFRS 18, if there's a transaction which affects P&L, you have to obviously tell us exactly under which category you have to show that impact. Number 1. Number 2, now try to understand. When we started the question, and I think it was written in the very first line, if I'm not wrong. Let's go back. Oh, just a minute. Let me just show you. It was written, yeah, you can see that. Wetengi company is a parent of a manufacturing group. Now, this is also very important. It's a manufacturing group, which means that investing and financing, these are not their main activities. Basically, Wetengi Group is a manufacturing group, which means that it is not their main activity to take loan and give loan, which is the main, you can say, category, main, I would say, business for the banks. But this is not the business here for the Wetengi company. It's not a main business for Wetengi company because Wetengi company is a manufacturing group. If it is not your main activity, so you cannot bring the impact to the operating category. In case of bank, if it is obviously in case of bank, it is the main category to take loan and give loan, then I'll be bringing my interest expense to the operating category. But here it is not possible because why? Wetengi is not a bank, you can say. It is not their main activity, which means that number 1, the loan which they have taken in a foreign currency, on that foreign currency loan, whatever interest, whatever basically foreign exchange loss they have faced, that loss will be treated as an interest expense. It will be technically go to the financing category and will be shown with interest on foreign loan. You cannot show that to the under operating category. That is the error. Another point, if you have overseas subsidiary, students, if you have overseas subsidiary, what they have done, another point, let me just tell you. Now come here, students. The foreign exchange differences comprise 200,000 loss relating to overseas loan incurred by Waiting. I believe as far as the explanation which relates to the loan is clear to everyone. Waitingi does not have its main business of providing and giving loan. I hope it is clear to everyone. Yes or no, please reply. So basically, whatever exchange loss they are bearing, that will be shown under financing category. So it will be a part of interest expense on borrowing. Okay, that 200 will be shown with interest expense on borrowing. I hope till here at least everything is clear to everyone. Can you please answer, yes or no? Okay. Then 20,000, the gain on translating 100% overseas subsidiary. Student, if you recall, IS, I would say 21. When we translate net asset of our subsidiary, on translation, either the gain comes or loss comes. We show that gain or loss in OCI. We show that in OCI. We do not actually, you are not allowed to net off this gain, this 20,000 exchange gain against the 200 exchange loss, because both loss and gain, they belong to different categories. Is that clear, students? Net off is not allowed at all. And existing treatment is obviously incorrect. So basically, exchange gain or loss on translating overseas subsidy, you have to show current year exchange gain or loss on translating overseas subsidy, we have to show in OCI. Logically, OCI will increase by 20. Student, till here, if everything is clear, then let me know, please. Yes or no? Okay. So the foreign exchange differences, now what they have done, we have to correct that as well. They have taken net 180 and they have increased what? Operating costs. Waitangi Gami is certain foreign exchange differences and these have all been correctly calculated net loss 180. However, the directors have not applied the requirement of IFRS 18 presenting this is classified all exchange differences as, so obviously it is not your operating expense. It is not your operating expense. Now let's come here. There are two impacts. Let's show both of them separately. Adjustment number 3, where basically we are after IFRS 18. Student operating cost, operating expenses, they have actually increased the operating expenses by 180. They've increased the operating expenses by 180. Yes or no? Please reply. Students, they have increased the operating expenses by 180. Yes. Keep that in. Again, I'm writing this. And how did they get 180? 200 is an exchange loss. And that exchange loss actually belongs to the borrowing. Just keep that 200 in your mind. Can you see the interest expense on borrowing is 500? Logically, this 500 will increase by 200. It will not increase by 180. Is that clear, student? Your interest expense on borrowing will increase by 200. It will not increase by 180. Which means that just focus on that. I'm writing minus 200 here. We know that this 500 will increase by this exchange loss of minus 200. Okay. Just a minute. And there is on translating the subsidiary, there's an exchange gain of 20, and that 20 we will take to the OCI, other comprehensive income. Number one. Number two, one more thing. If you read the question, it's a 100% subsidiary. If it is 100% subsidy, so can I say that entire 20 logically belongs to parent's equity holder? There's no impact to NCI. Why? Because the holding of parent is 100%. Is that clear? Students, please reply. Okay. One more thing now, let's see how much information they have given us in consolidated SOCI. Because in OCI, if you recall, there are two classification. One is items, they will be recycled, they might be recycled to P&L, and items they will not be recycled to P&L. Items, other comprehensive income items that will not be recycled to P&L. If you sell overseas subsidiary, on the disposal of overseas subsidiaries, all the cumulative exchange gain or loss which you have previously recorded in OCI, that will be recycled to P&L. Which means that items that may be recycled to profit and loss exchange differences on translating foreign operations, which they have shown 0, it has to be 20. And logically, it is transaction number 3. I'm just writing here. So student, you are just not supposed to write 20 in OCI. You have to take care of this classification as well. It will come under OCI in a category which might be reclassified to P&L, obviously on the disposal of my foreign, I would say, subsidy. Okay, now come here. Operating cost, it has increased by 180. Now student, I have to reduce the operating cost by 180. How I'm reducing it, that is very important. Please look at this. I'm writing minus 20. Why minus 20? Just wait for a minute. In the next point, I'm writing positive 200. First of all, you should understand one thing. Minus 20 and plus 200 will give me positive 180. Yes or no? Please reply. Yes. At least one thing is clear to everyone, that by doing this minus 20 and plus 200, actually we are reducing operating cost. We are reducing operating cost by 180. Okay. Now actually why we are doing it? Try to understand. Exchange loss. Actually, exchange loss has increased your operating cost by 200, and 20 is an exchange gain. 20 is your exchange gain. Logically, which has reduced the operating cost by 20. So this is how net 180 impact has increased the operating cost. So how we are reducing it? Actually, I'm taking out the gain which is minus with minus 20. I'm taking out the loss which is positive 200. Is that clear, student? Yes or no? Please reply. Okay. And plus, while explaining this part, you have to tell your examiner that entire 20 actually belongs to parent. Why entire 20 belongs to parent? Student, reply me. Why entire 20 belongs to parent? Because it is 100% subsidy. It is 100% subsidy. The reason is it's a 100% subsidy. There's no, I would say, impact on. It has no impact on your NCI. There's no NCI at all. Okay. Now come here. Student, now you need to understand one more thing. Parent, 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 parent. Profit attributable to parent. Student, we have got profit attributable to parent. 9,000. Now you need to understand one more thing. When they were preparing this group SOCI, what they did, operating cost, they actually reduced the operating cost technically by 20, which is the gain amount. Okay. And they increased the operating cost by 200. Student, is that clear? They actually reduced. They actually reduced the operating cost by 200 or 20, which is the gain. And they have increased the operating cost by 200 loss. First of all, try to understand one thing. What I'm doing, I'm reducing the operating cost by 200 and I'm bringing this 200 to the borrowing cost. I'm saying this 200 becomes a part of borrowing cost. This 200 will become the part of interest expense. Now try to understand one thing. If this 200 was initially added to the operating cost, now from operating cost, I'm excluding this 200 and I'm adding this to the interest expense. Overall, it will have no impact on the total profit which is available to parent's equity holder. Why? Just think, I'm reducing one cost, I'm increasing another cost. So logically, overall, it will not change profitability, which is attributable to parent's equity holder. Student, comment on that, please. I'm reducing one head of cost, I'm increasing another head of cost. So I'm saying it will have no impact on the overall profitability, overall profit, which is attributable to parent's equity holder. Yeah, it's just a matter of presentation. Yes. But now, students, look at this gain of 20. The gain of 20, try to understand the gain of 20, what that gain of 20 has done. Actually, number one, we know that 20 we have to take it to OCI. It's not a part of, let's say, P&L. But I want to say one thing. Logically, that due to this 20, operating cost, the P&L which they have already prepared, the SOCI and which they have already prepared, in that group SOCI, operating cost is reduced by 20. Due to that, profitability which belongs to parent's equity holder, it has actually increased by 20. Comment on that. Students, they have actually reduced. Great. So actually, what we want to say that 20 should you okay, it belongs to the parent, no issue at all. But the main thing is you have to show that to the in your main classification. The classification is under OCI. You have to show that 20 to the exchange differences on translating foreign operations, nowhere else. Which means that now come here. Exchange differences on translating foreign operations, that will actually increase by 20. And profit which is attributed to parent's equity holder, this 9,000, logically it will reduce by 20. Student, is that clear? Please comment on that. Okay, great. So this 20 will reduce the profitability. So impact of 20 is we have to show 20 under OCI, exchange differences which might be reclassified to P&L, and whatever existing treatment they have followed, due to that they have actually increased the profitability which belongs to parent. So parent's equity holder, so we have to reduce that. Okay. That is all about adjustment number. That is part C. All about IFRS 18 presentation. D, using exhibit 4. Again, explain how a Tengi company should account for the sale of 10% interest in Hassan's in its consolidated financial statement. Okay. Using exhibit 4. Explain how a Tengi company should account for the sale of the 10% interest. Let's see, 7 marks. This time we have got 7 marks. Let's go exhibit 4. Exhibit 4. I think this is the exhibit 4. Yes. Tengi company had purchased 90% controlling interest. Parent 90. NCI 10. Hassan for 90 million. On consolidation of the subsidiary, non-controlling interest was measured at fair value. It means whatever is the Goodwill method, it is a full Goodwill method. Why full Goodwill method, student? Please reply. Why we are saying whatever method they are following is a full Goodwill method? Because they are keeping NCI at fair value. Okay. During the accounting period, Vitenghi company sold 10% of equity of Hassan for 25 million. Student, from 90, parents holding will become 80. NCI from 10, it will become 20. Can I say from 90%, if parents holding becomes 80, parent will remain, parent control will not be lost. If you recall, student, if the control is still retained, control is not lost. So can I say it's a transaction between two owners? And when there is a transaction between two owners, whatever the gain or loss comes on disposal, we have to take that gain or loss on disposal to OCE, other component of equity. Even you cannot bring that gain or loss to OCI, not acceptable. When there's a transaction between two owners where control is not lost, whatever the gain or loss comes, that we have to show in O. CE. Okay. During the accounting period, Weitengi company sold 10% of the equity of Hassan for 25 million. Okay. A gain of 15 million being the difference between the sale proceed and the cost of the shares sold has been recognized in group equity and reported in group other comprehensive income. They made a mistake. What they have done, let me just tell you. Weitengi bought 90% for 90 million. Now they sold 10% for 25 and they recognize a gain of, this is what they have done. It means just what they have done, I'm telling you. Disposal proceed 25, 90 million, they bought 90 for 90 million, they bought 90%. They are selling it 10%, so obviously 10 million. The gain is 15. Let me tell you, recognizing the gain of 15 million in individual books is okay. There's no problem. In individual books, there is no issue at all. Is that clear? So in individual books, there is no issue at all. In individual books, this is how we recognize gain or loss on disposal. So basically, having this gain of 15 in individual books is not an issue. But right now we are after group SOCI. So can I say in group SOCI, first we'll be explaining our examiner. It's a transaction between two owners. Control is not lost. Parents holding from 90, it will become 80. NCI holding from 10, it becomes 20. Whatever the gain or loss comes, actually that gain or loss, whatever the gain or loss comes, that gain or loss we have to show in OCE. Even we cannot show that to OCI. Okay. At the date of sale, the net asset of Hassan 170. The non-controlling interest they have given us 13.5 million. The goodwill is 10. So simply, if I just give you the double entry, parents sold 10% equity for 25 million. So net asset at disposal, they are 180, 170 plus the goodwill. Why plus goodwill? Because of full goodwill method. 180. Now 10% of that belongs to NCI. 18. Balancing figure is gain on disposal. That we have to show in OCE, not even in OCI. And this is, you can say, is a balancing figure. I hope it is clear. Yes or no, please reply. Students, can you reply, please? Okay, I'll repeat. Parent was having 90% holding, from 90, parents holding becomes 80. Number one, from 90, if your parents holding becomes 80, so control is not lost. When control is not lost, it is treated as a transaction between two owners. And when there's a transaction between two owners, whatever the gain or loss comes, that we have to show in OCE. Okay. Another point, if I talk about individual books, in individual books of parent, this is how we calculate gain or loss. Disposal proceed 25, cost of investment, please don't use any button, something like that. Cost is 10 million. How did I get this 10? Actually, parent bought 90% for 90 million. So it means 1% for 1 million. Now you have sold 10%. So the cost of that 10% is 10 million. Disposal proceed is 25. The cost is 10. So the gain on disposal is 15. But that gain on disposal 15 we have to show in individual books, not in group accounts. In group accounts, how do we calculate gain or loss? Bank or cash debit by 25. Net asset at disposal 170 plus goodwill. Why I'm adding goodwill? Because it's a full goodwill method. That is why 170 plus 10. 10%, it will increase, NCI value will increase by 18. So the balancing figure is coming on credit side, it means gain on disposal. And that will go to OCE, which means that first I'll explain to my examiner that gain of 15 million is okay in individual books of parent, but we cannot recognize that gain in group SOCI. So this 15 gain will be eliminated from group SOCI. Second, you will have to explain it's a transaction between two owners. Whatever the gain or loss comes, that will go to OC, and then you will explain the amount of the gain is 7. And little bit more explanation that parents holding from 80 becomes from 90 it becomes 80, NCA from 10 it becomes 20. And gain of 15 million being the difference between the sale price and cost of the shares sold has been recognized in group equity reported in. So they have taken that 15 to the other comprehensive income. So can I say OCI will reduce by 15 million? Kindly reply, students. OCI will reduce by 15 million. Which means that if we go to the pre-populated SOCI. So your adjustment number 4 is having one impact. OCI will reduce by 15. 15 million, 15 million. OCI. Look at this. Gain on the sale of shares. Items that will not be recycled to be a gain on the sale of shares. This 15 has to become what? It has to become 0. Gain on the sale of shares. Is that clear, student? This 15 will have to become 0. So last adjustment is minus 15,000. I hope it is clear to everyone, all the adjustments. Yes or no, please reply. Okay. So student, I have explained you all the 4 exhibits, plus I have explained you properly what is their impact on pre-populated SOCI. Let me just quickly share the answer of pre-populated SOCI and let's see what they have done. And if you have still any queries, you can ask. Let me just save this one. Okay, it's not going anywhere. Let me just bring the answer. Student, this was adjustment number 1. Student, this is how you have to deal in your final exam as well. After doing exhibit 1, you have to go to the last requirement and adjust your pre-populated, either it is SOCI, SOFP or group cash flow statement. Fair value adjustment, I think we did the same thing. Operating cost, 250. 80% is given to parent, 20% is given to NCI. Perfectly fine, no issue at all. Impairment, there was impairment of 2000. I think 60-40 was the split. 60%, if I take 60% of 2000, it is 1200 and 40% is 800. 1200 will reduce profit attributable to parents equity holder. 800 reduces NCI. Carries on here. And this is IFRS 18. Exchange gain. We are technically excluding the exchange gain from the operating cost. And we have to show that into OCI. And due to that exchange gain, by mistake, parents profit attributable to parents equity holder, it has increased. So we are reducing it. Okay. Then this is the 200. This 200 exchange loss actually belongs to the financing category and will be a part of interest on borrowing. And you can see that this 200 does not have any impact on profit attributable to parent's equity holder because just the difference in the presentation, net impact is same. Then the last one is OCI. We have to reduce this 15,000. Gain on the sale of shares. I hope it is clear to everyone. Yes or no, please reply. And if you use the calculator, I think they forgot to deduct 15,000 here. Let me use the calculator. From 24250, we'll deduct minus 200, minus 1200, minus 15,000. Then we'll get 7850. Let me check. 24250 minus 200 minus 1200 minus 15,000. Is that clear, sir? I think maybe a typing error, something like that.